In this video, we're going to look at what I think are 5 of the most common trading mistakes. Hello, I'm David Jones, and in this latest video with Capital.com, what I thought we'd do is take a look at trading psychology. So this is the first of a series we're going to do, and I thought the best way of starting was to highlight 5 of what I think are the most common trading mistakes. Then over the next few weeks of videos, we'll look at ways we can address these. In theory, trading is pretty straightforward. We want to buy low and sell high, or if we're selling short, we want to sell high and buy low. Of course, if you've ever done any trading, you'll know it's not quite as straightforward as that, and our psychology gets in the way. So I thought if we identify maybe some of these problems right at the start, we can put methods in place to try and deal with them, and that's what we're going to do in the next few videos. But today we're going to take a look at these 5 mistakes. So let's get started, I think, with common mistake number 1. So let's have a look at mistake number 1. Trading against the trend. I think this is part of human nature, and it's a very difficult thing to overcome when it comes to trading. We see a market that's been sliding and we want to be a buyer. We see a market that's been rallying and we want a seller. We want to be a seller. We want to try and call the top, when really, we should be going with market sentiment. So let's just look at a couple of examples where this would really hurt our trading account. Let's use the pound US dollar as our example here. The hourly chart we've got from middle of April is a bit I'm interested in. When we really started sliding into the end of April. Now there could be the temptation here to be a buyer. We've seen the market go from 143.70 down to 139.30. It's a big move. If people are looking at the RSI, they might be tempted to be a buyer. But obviously that trend is still down. It's only 3 hours ago that we saw a fresh low hit for this trend, but there's always the temptation to go against these major trends. Let's see what happened next. So I've zoomed the chart out and taken it forward in time. This was the bit we were looking at where we were thinking, okay, shall we go against the trend? The market went sideways. Then look what happens. It drops another 400 points or so over the next 10 days. So again, a trade here going against that trend would not have been the sensible thing to do. Of course, it applies in the other direction as well. This is a daily chart of Netflix, the US listed video streaming company. So let's look where we were. So if we go back to here, 2016, October 2016, the price is trading around about $100 a share. By October the following year, it's been as high as 200. So some people may be thinking, well, okay, is it time to go short? The price has risen an awful lot. Let's not forget that trend is still up. But let's say they're betting the price is going to drop from here. Let's see what happens next. So we've jumped forward in time. We were looking at it sort of here at $200. We had a little wobble, but then over the course of the next 6 to 7 months, the price rose by more than 50%. So again, I think this just demonstrates the importance of not betting against major trends in a time frame you're trading. So there we go. I think a lot of trading goes against human nature. If we see a market that's done that, we want to think about picking a top and selling it. If we see a market that's doing that, we want to think about picking a bottom and buying it. And that does tend to go against the broader market sentiment. That's why we trade against the trend. Let's have a look at mistake number 2. So let's look at another trading mistake, number 2. Risking too much on any one trade. This is really trading too big, being too confident that our opinion is going to be right, risking, let's say, half of our trading account on any one trading idea. That's never a good approach. In trading, we want to be able to withstand a series of losing trades. If we risk half of our account on any one idea, we've got to double our account if we end up losing just to get back to where we started from. So the sensible approach is to trade relatively small on any one trading idea in relation to the size of our account. So risking too much on any one trade, this boils down to poor money management. And many people in the beginning, don't appreciate just how important money management is. Do not bet significant chunks of your account on any one trading idea. And we'll look at this in a lot more depth in a video in a couple of weeks' time, how to use sensible money management. Let's take a look at common trading mistake number 3. Taking profits too quickly. This is a really common problem. Again, I think it feeds into human nature. We see a profit, let's say we're up £50 on a trade. The market starts moving slightly against our position, so suddenly we're only up £40 on the trade. The temptation is to snatch at those profits and close the trade out. Let's take a look at why this might not be the best approach. Let's stick with Netflix when it comes to taking profits too early. So what we're looking at is the edge of the chart, October 2017. You've decided to buy in because the trend's up, so you're a buyer at around about $180 a share. So far, so good. Let's jump forwards a bit. So just a couple of weeks later, the price has traded above 200, has started coming off a little bit, so maybe you're getting nervous now and worried the market is going to snatch away your profit. So you decide to come out of the trade for a $10 profit in this example. Let's walk forward and see what happens next. The price does wobble a little bit lower. It would have gone back to your entry point, 180. Spent a bit of time going lower, but if you had no strategy for getting back in, you would have sat there and watched the price of Netflix continue to push higher. Eventually, at the time of recording, getting as high as about $3.40 a share. So this is clearly the drawback of getting spooked out of trades too early and snatching at the profits. So I think that's another one that does go against sort of our own sort of human nature, where if we see a profit and it starts disappearing, we panic and we snatch at profits. The market doesn't care how much of your profit you're giving up. But there are things we can do, I think, to try and have a more disciplined and rigid approach to taking profits. We'll look at that in a few weeks' time. But let's take a look now at mistake number 4. So we looked at taking profits too quickly in the previous mistake. Let's look at the next common mistake. Letting losing trades run. This combination is what most traders do, and they end up losing money. So they snatch at profits, and if a trade starts going against them, they hang on in the hope the market's going to turn around and start showing them a profit. Let's look at an example at why this can be a very dangerous thing to do. When it comes to letting losing trades run too far, let's take a look at the euro dollar. This is a 4-hour chart, and what we're looking at here, this is the end of April 2018. I think this is a perfectly sensible trade to do. We've seen the market come down to 121.50 quite a few times and hold, and over the course of the last 8 hours the market's held again. So buying here with a stop loss below, this is the important thing, seems a sensible trade to do. But let's say this is a person who has a problem in taking losses. Let's just jump forwards a little bit. So the market's broken below this big support. That's a pretty major break. We're breaking below a 3-month support line. So it looks like the trade isn't going to work out. It's time to take the loss on the chin and move on. But plenty of people might have a problem doing this and think, well, I'll just hang on because maybe it will still go in my direction. Let's jump forwards a bit more. So here we go. We've jumped forwards a few days here, and you can see the danger in not taking your losses at a predetermined level. So the trade that had a loss of, let's say at max 100 points, has ended up with the trade now where we're about 250 points. The market is 250 points against us. So again, here we have the classic problem of letting losing trades run. If you end up with a much bigger loss than you were planning on because you can't take your losses on the chin, then it's going to wipe out so many previous profits. So I think, as I said, mistake number 4 is really tied up with mistake number 3. We take profits too quickly and we let losses get out of hand. There was a study done a few years ago, and it looked at how the average trader performed, looked at millions of trades, and the average profit was about half the average loss. So if you're making £100 but losing £200 on losing trades, clearly the probabilities of you being profitable are massively against you. So we will look at this whole idea of letting your profits run and cutting your losses quickly in one of the part of the series on trading psychology. But to wrap things up, let's take a look at mistake number 5. The final trading mistake is really a combination of all these factors so far. It's having no trading plan. So just jumping in blindly without a regard for what the trend is, risking far too much on any trade, not really having an idea about where we'll take profits, and not having a level that we're committed to where we're going to get out if the trade goes wrong. So all of this adds up to not having a trading plan at all. So I think not having a trading plan is really a combination of those 4 previous common trading mistakes. Your trading plan doesn't need to be an entire book of what you're going to do. You know, it can be just a few lines on a piece of paper, but having an idea about where you're going to enter a trade, what the conditions need to be, where your stop's going to go, where your profit's going to go, how big you're going to trade, all of these sort of things. But plenty of people just jump in. So one of the videos we do will be looking at how do we construct a sensible trading plan that's right for us. So this has been an overview of what we're going to look at in the next few weeks, just highlighting some of these common trading mistakes. If you have any questions or comments, leave us a message in the comments down below. If you like the video, click on the thumbs up. And to not miss out on this series, make sure you're subscribed to the channel by clicking subscribe. And also down there's that alarm bell notification icon. If you click on that, you get notified every time we upload a new video as part of this series. But for now, we'll wrap the introduction up there until the next video. So from me, David Jones and Capital.com, I hope you have a good trading week.